First, there was the High Return Real Estate Show, now upgraded to the Higher Return Real Estate Show. Deeper insights, greater value. It's time to build your empire.
Back in the year 2000, I read one of the all-time classics in personal finance, Rich Dad, Poor Dad by Robert Kiyosaki. The concepts in that book completely changed my beliefs about investing. One particular concept that has stuck with me was his definition of financial freedom. The true definition of financial freedom, according to Kiyosaki, is when the income from your assets is enough to cover your monthly expenses. From that point on, you are truly free because you no longer have to work for money. You can do what you want when you want to do it with who you want. You are no longer tied to a paycheck. In today's episode, we'll dive into step number 5 of the 7-step strategy, which will help you focus on developing multiple streams of passive income to create financial freedom. With the amount of technological disruption that will take place over the next decade, you will not only want, but need to have income coming in from different sources to protect yourself. Remember, Blockbuster was a multi-billion-dollar company, and within a few short years, Netflix completely wiped them from existence. I'm going to give you some very specific examples of different assets you can invest into. Our goal is to become financially free. Well, how do you become financially free? As Robert Kiyosaki described in his book, the true definition of financial freedom is when the income from your assets pays for all of your monthly expenses. So in that scenario, you are now free to never have to work again. Your assets are creating passive income flowing in to cover and more than offset your outgoing expenses. That's true financial freedom. So a lot of people think, okay, when I'm a millionaire, I'm going to be financially free, which is not actually the case. You can be a millionaire in portfolio, where your portfolio is worth $1 million, but if it's not kicking off the amount of money and cash flow per month that you need to pay all your expenses, then you're going to have to continue working, or you're going to have to start drawing down on the principal. If say you stopped working, you would have to slowly start drawing down on the principal of your total portfolio. And at some point, you would run out of money, right? So we want to avoid that situation where we ever run out of money. And this multiple streams of safe cash flow is what's going to get us there. And what's critical to the successful implementation of this strategy is the asset allocation model. You've got your safe, steady, predictable returns from your boring whole life cash value insurance policy, from your mortgage-backed notes, from your cash flow real estate rentals, from your blue chip dividends, from your private money loans, maybe even some tech royalties from cryptocurrency, and even some out-of-the-box type income strategies that you think of that maybe I'm not even thinking of, right? There's plenty of out-of-the-box ways to generate income.
Hey, thanks for supporting our show. If you want to find great rental properties that are not available to the general public, subscribe to our Insiders Club email list. Just head on over to highreturnrealestate.com and wait for the pop-up.
So with those solid income producing assets in play, then you can comfortably and aggressively take some swings for the fences. What if those riskier, high reward plays don't work out? You aren't knocked out of the game. Your income producing assets simply replenish those funds in short order, and then you reload and you figure out the next play. You see, without getting some investments that grow quickly and significantly in our portfolio, it's going to take a very long time to reach your financial goals and truly live the kind of life you want. So this is not a get rich quick strategy. However, we can get there quicker and more balanced and without having such huge swings that most people go through when they invest into, all their money into risky, big swings, right? So we're just going to take some well-calculated plays that have much greater upside than they do downside. When I was in college, I talked about that I saved up $50,000 after hustling and saving and building a private business. And then I put all of that into risky tech stocks, and I bought a home instead of renting. The tech stocks crashed in the 2000 dot-com bubble burst. The money in my home was locked up in the mortgage, which I couldn't touch. So that's what we call a lazy asset. It's equity that doesn't produce any cash flow. So I was knocked out of the investment game. So I want to make sure you build your wealth in a way that doesn't get you knocked out of the game like I did. It took a few years of rebuilding before I was able to jump back in, losing valuable years, very valuable years of compounding. Those early years that you lose when you do too risky of investments, that compounding is so critical, and that foundation is so critical to your long term. So let's dive in and let's talk about some of these conservative assets just to start getting your minds thinking about what are you going to invest into? How are you going to get it? Where are you going to get it? What's it going to look like, right? So let's talk about high cash value whole life. So to me, this is the foundation of everything that you're going to build with your plan. The reason why is it's not like a great investment. I mean, it only goes up like 3 to 5%. Mine's probably 5.5%, I think is what we figured out after tax return. So guys, that's not like I'm never going to get financially free on that. That's going to take a long time. But what that does is that creates dividends that keep coming in year after year. And with those dividends coming in, I can take those dividends as cash flow if I ever needed it. Or better yet, I can borrow against that policy if I ever need cash and get into a jam, or if the market suddenly just drops in value and there's assets that are incredible that are on sale, I can go in and within a week or less, I can have a chunk of the cash value out of my whole life policy and utilize that to invest and to create more income. So this is more it's a foundational play. It's a stabilization play. It's more of a savings play. And it's to protect my estate. If anybody ever, sues me and wins a lawsuit, they can't ever touch my whole life policy. It's off the table. All right, let's talk about cash flowing real estate rentals. And I have about 20, I think, total real estate properties, maybe more. If they're a little bit, disrupted, like if maybe if the neighborhood turns or I'm having too many, tenant or maintenance issues on a property, I'm probably going to sell it. So it's a moving target, but I have over 20 right now that are producing cash flow. What's great about real estate rentals is that you can leverage it. Let me give you an idea. Let's say you got $100,000 in cash that you have to invest, right? So you buy a property with cash for $100,000 and it's a nice, quality B type property, maybe a B plus. It's kicking off $1,000 in rent per month. After all expenses and everything, let's say you cash flow $500 a month, right? So that's about $6,000 per year. Maybe you'll get $800 in cash flow. That's probably on the higher end. But let's just say after, all expenses paid, $8,000 net comes in. On $100,000 investment, that's an 8% return, right? But what's great about real estate is that you can leverage it. This is one of the few asset classes where the bank will loan you money to buy it. So now you could take $100,000 in cash and you can buy 5 properties for $100,000 each, because you're going to put 20% or $20,000 down and you're going to finance the rest. So now your $100,000 acquired you $500,000 worth of cash flow producing assets. Now you've got debt to service. Okay, so that's going to take additional money out of your monthly cash flow. However, a portion of that is going to go towards the principal. And as you hold on to the properties, every year, more and more is going to be paying down the principal, or what's called the debt amortization schedule. So the way I think about it is that every time my tenant makes the payment and I use that money to then I take that rent money that's coming in, some of it I get to keep for myself because it's excess cash flow over and above my expenses. And then some of it is being used to pay down the debt. The portion that's paying down the principal is increasing my wealth, because now that's increasing the equity that I have in that property. And so now with leverage, you guys, I can take that same $100,000 and I can turn it into, instead of $8,000 in net income, I can turn that into $16,000, $20,000, $25,000 in net income for the year, because now I have 5 properties that are producing rent instead of 1. So real estate is so important to leverage, in my opinion. You can multiply by usually a 2, maybe 2.5 times factor the net income or net cash flow that comes out of a property when you use leverage. And on top of that, what's great is that, say that $500,000, the market value goes up to $600,000 of those properties. So you just increased the value of your assets, went up $100,000, but you only have $100,000 in cash invested, right? So now not only did you create cash flow from the monthly rents, but your properties went up 100 grand. So your actual cash just doubled from 100 to 200,000. That's the beauty of leveraging cash flow real estate that Robert Kiyosaki talked about in his plan. Now, where do you get cash flow real estate rentals? And where do you buy them? Chances are pretty good that it's going to be tough for you to find good cash flowing properties that are, quality management in your own backyard. So lucky for you that over the last 5 years, I've been building out a company that allows you to be able to purchase properties in multiple markets throughout the Midwest. Our company was only we were only able to acquire and renovate properties in the Indianapolis market. And now you're going to be able to, have access to great quality properties that have good cash flow potential in the Midwest. Now, let's talk about mortgage-backed notes. The way you think about mortgage-backed notes is essentially you're becoming the bank and you're holding the mortgage note that another person is paying interest to you on. Now, these are the ones that we're talking about here are not done like through a traditional bank. These are private type of deals, like off-market type of deals. So you're going to be able to purchase mortgage-backed notes that have a higher interest rate, and you're going to be able to get 7, 8, 9, even 10% interest rate on these notes that you hold, which is going to create some additional streams of solid cash flow. Now, what happens is there's risk to every asset, right? The risk of having a mortgage-backed note is that, the person on the other side stops paying you, right? That's always the risk to a bank. However, in these types of situations, if that were ever to happen, you're probably pretty excited because there's equity that's in the property that you're going to be able to then, you're going to be able to foreclose, take over that property, and you're going to be able to capture all of that equity that's in that, that's in that property. Now, it's very rare for that to happen, like less than a 1% chance of that ever happening, but that's the risk that you have with mortgage-backed notes.
Hey, thanks for being a listener. To find great rental properties and become a more savvy investor, head on over to highreturnrealestate.com.
All right, so let's talk about blue chip dividend stocks. Okay, so this is where you're buying, large established companies that just continually kick off cash flow. They're proven, they're stable, they're solid. You're not going to get big swings in prices of these companies. They're very safe, stable, solid, conservative type companies that often have been around for multi-decades, and they've proven themselves out with their product, their services, their management team, their leadership, and all of their structures, right? So there's companies, say like Ford Motor Company been around for 100 years plus. They have stability, even throughout the worst of times in 2008, they made it, through without any problems. This company pays out a dividend on their stock. So that dividend is issued to you in the form of cash, okay? So you get a quarterly, typically type of payment that comes into your account, and that's creating income for you, safe, conservative income, passive income that you're going to be able to utilize to fund your whole wealth building strategic process. Now, there's also a thing called private money loans. Now, I don't recommend for new investors to do these because you definitely have to know what you're doing and who it is that you're loaning money to. A private money loan is just a simple arrangement where you loan money to an individual, you draw up a contract, and then you're loaning them money to go out and say start a business is how it usually happens. Now, I've done a few of these and they have all worked out so far. Everybody has made their promises that they kept their promises that they made, and they've paid on their notes or paid me back at the times that they were supposed to pay me. However, again, just a slight caution, unless you're very confident in the individual, because that's ultimately who you're investing into is the person. If you're confident in that person and their ability to repay and keep their word, and you also if you can somehow collateralize the loan against an asset that they own, then these can be really great strategic ways to increase your wealth. Now, why would this person want to do a private money loan and pay you in all reality a higher interest rate than they would if they went to the bank? Well, typically it's usually because they just don't have enough credit, or maybe it's a business that is unproven, so the bank isn't willing to take the risk. Banks in nature are very conservative. They're only going to loan money to absolute sure bets. Like they have any doubt that they're going to have lose their capital, they're not touching it. So for you taking on a higher risk, you're going to be able to also get a higher interest rate as well. A lot of private money loans, for me, I get paid 10, 12, even 15%, on my private money loans. And that's pretty standard, and that's pretty par for the course. They're also called hard money loans because the terms and conditions of the interest rate are a bit harsh. But it is what it is. It's both people coming together in the market, creating a contract that they're both willing to take on, and they're both agreeing to. Nobody's forcing anybody to pay the higher interest rate. They need capital, they need liquidity to get their business going. They're going to have to probably, in all reality, pay a higher interest rate to make that happen. When we were starting our company, High Return Real Estate, we needed an influx of cash to be able to take on more properties and rehab more properties because we had a high demand. We had a lot of demand for properties and we didn't have enough supply. So we needed to bring in some capital. My very first private money loan was for $500,000 and I paid them 15% interest for that money. Now, looking back on it, I'm like, man, why did you do that? That was a serious amount of interest that you're paying them per month, right? Well, we were able to outpace that interest with our sales and creating additional revenue. So we made money off of that private money loan. So it was a win-win situation. And then we found another investor who was willing to come in at a lower interest rate. So he loaned us money at 10% interest. Then we took that money and we paid off the first lenders, got them all paid off, cleared off, and then we started making payments at 10%. So I've been on both the giving and the receiving end of the hard money private loans, right? And I understand how to structure them. So that's just a kind of giving you guys ideas of how you're going to create additional streams of passive income. Now, there's another one that I love that's relatively new, and it's called tech royalties. And this is where you're buying cryptocurrency assets and then you're able to stake those currencies. Okay, and this is not something I'm going to get into and dive into in detail on this particular show. I will create another podcast that will explain how tech royalties work. But you're gonna be able to stake those currencies. In other words, you can either kind of loan them back out to somebody else who wants to borrow against your cryptocurrency, and then you're going to get paid an interest rate for doing that. Big one called BlockFi, where you can buy any of your Bitcoin or your Ethereum that you own. You can stake it on that platform, and in exchange, you're going to get a 6, 7, 8% interest rate on your cryptocurrency as you hold it, which is an incredible way to create an extra stream of income off an asset that you really normally probably weren't even thinking about doing anything other than buying, holding, and speculating and hoping that it goes up. So that income that's kicking off, those tech royalties, is creating an additional form of income off of your assets as you wait for them to go up in price. It's just like cash flowing rental real estate. If it never went up in value, but it's kicking off that net cash flow from the rents, you're winning. If it goes up in value, then you're making even more money. You're increasing your overall net wealth. So you can win in those types of games both ways. And then there's out of the box income opportunities. I saw one of my partners and friends, Adam, he posted that he was mining cryptocurrency. And so I hit him up. I'm like, dude, is there a way that I can get a piece of that? Right? I saw an opportunity. And I don't know anything about how to do it. I don't know how to set it up. I kind of understand it, but I don't totally get it. But I do know that Adam's super intelligent. He's super smart. He's a tech wizard because we've done technology projects and built platforms for other businesses together in the past. So I said, look, if I give you some capital infusion, can you buy, more mining equipment? And then, we'll split up some of the income that comes off of it. And, we'll both win. He's like, yeah, that's a great deal. We started buying up the components that you need to mine cryptocurrency. So it's created a situation where money that, would have traditionally been like conservative with, right? And I'm putting it into this crypto mining project. And man, the returns are incredible. As of right now, we're on track. I'm on track to get all my money back, all the equipment paid off in roughly about 8 months. And then from there, it's just free flowing cash flow that's going to be coming in as this system continues to crank and create more of the mining income. Wanted to get you guys just thinking about different ways and different means that you're going to be able to tap. I want to give you the why, but I also want to give you the how to and the where to buy, right? The where to get it.
Hey, thanks for your support. If this episode was valuable to you, then show us some love. Subscribe and take 1 minute of your time to leave us a review. This is how we get the word out to help more investors. And best of all, it's good for your karma.